Hello everyone, this is Rabi Ahmed from Accountancy Coach. Today I'm going to be talking about IAS 38 Intangible Assets. So what are intangible assets? An intangible asset is an identifiable, non-monetary asset without physical substance. For example, patents, brand names, computer software, customer lists, licenses, etc. Now, the three critical attributes of an intangible asset are identifiability, control, future economic benefits. What do you mean by identifiability? An intangible asset is identifiable when it is separable, which means that it can be separated and sold or transferred or licensed, etc. Now, then the second thing, control. What do you mean by control? Control here can mean that you have the power to obtain benefits from the asset. Then we have future economic benefits, such as revenues or reduced future costs. Initial recognition. IAS 38 requires an entity to recognize an intangible asset, whether purchased or self-created at cost, if and only if it is probable that the future economic benefits that are attributable to the asset will flow to the entity, and the cost of the asset can be measured reliably. Initial measurement at cost. Cost plus any directly attributable cost, example the legal fees or the testing costs. Then we have the subsequent measurement. It has two models, the cost model or the revaluation model, also known as the fair value model. In the cost model, it is carried at cost less accumulated amortization and impairment losses. In the revaluation model, it is carried at a revalued amount based on the fair value less any subsequent amortization and impairment losses, but only if the fair value can be determined by reference to an active market. Such active markets are expected to be uncommon for intangible assets. So the examples where they might exist could be production quotas, fishing quotas, taxi licenses, etc. Revaluation surplus. When a valuation indicates that the fair value of an intangible asset is greater than its carrying amount, the amount of the surplus is generally recognized in other comprehensive income and accumulated in the equity as a revaluation surplus. However, if the increase in the fair value of the asset reverses a previously recognized decrease in the fair value of the same asset, it is recognized in the profit or loss to the extent that the previous decrease was recognized in profit or loss. Revaluation deficit. When a revaluation indicates that the fair value of an intangible asset is less than its carrying amount, the amount of the deficit is generally recognized in the profit or loss. However, if the decrease in the fair value of the intangible asset reverses a previously recognized increase in the fair value of the same asset, it is recognized in other comprehensive income to the extent of any credit balance in the revaluation surplus in respect of that asset. Then, the decrease reduces the amount of revaluation surplus. Here, I'd also like to point out that the treatment of revaluation surpluses and deficits arising on intangible assets is the same as that for the items of property, plant, and equipment. Research. Now, the research expenditure is charged immediately to profit or loss in the year in which it is incurred, whereas the development expenditure must be capitalized when it meets all the criteria, which is sell and use, commercially viable, technically feasible, resources to complete, measure cost reliably, and probable future economic benefits. This means that the entity must intend to and be able to complete the intangible asset and either use it or sell it, and be able to demonstrate how the asset will generate future economic benefits. Lastly, we have internally generated brands. The cost of generating an intangible asset internally is often difficult to distinguish from the cost of maintaining or enhancing the entity's operations or goodwill. For this reason, internally generated brands, mastheads, publishing titles, customer lists, and similar items are not recognized as intangible assets. Thank you so much.